Wells Fargo dropping hundreds of independent auto dealerships as customers, according to a new report from CNBC.com's Hugh. The bank says it will no longer accept auto loan applications from most of those businesses. Hugh joins us now with that story. Hugh, what can you tell us?
Yeah, so a couple of things right up the top. I mean, independent dealerships, you have to think of those versus the franchise dealerships. So franchise dealerships are like a Honda, a Ford dealership, and independent car dealerships, they tend to focus on used cars specifically. So what Wells Fargo is saying, and the company line from Wells Fargo, is that they're doing this because they see the credit deteriorate potentially, so that they're worried about the way that this is going to come back to them. As you know, banks have spent billions and billions of dollars to shore up their reserves for credit losses.
Yeah, Hugh, I mean, I think it's so interesting that they've taken this specific step, and certainly there'll be some considerations about the credit risks in that subsector. But you've also got a quote in your article from what Charlie Scharf, the CEO, was talking about last Friday when he presented at the Bernstein conference, which also relates, of course, to the flexibility that Wells Fargo has at the moment with the asset cap it faces, and it can't continue to be loaning and therefore generating assets to all areas. It therefore faces more stringent controls than other banks, and it has to cut back in some areas. This is one of the areas it's chosen to do so.
I think you're absolutely right, Wolf. I think they are underplaying the impact that the Fed asset cap has made on them. Essentially, with a lot of corporate clients rushing to come in and take out those huge billion-dollar revolver lines, they're stuck in a position where they have to pick and choose among which customers to keep and which customers to cut loose. And it appears at the moment that they've decided to cut loose these independent car dealerships, which, as you know, would have an impact on the amount of credit that's available to people as they attempt to buy used cars.
So what's your take, Hugh, as to whether this is sort of Wells Fargo uniquely being conservative, or whether we should be broadly more worried about credit losses coming down the pike in all sorts of industries, including autos?
There's been reportage that, particularly in the subprime auto loan space, that, people have $40,000 loans on $30,000 cars. As you know, the cost of cars have been rising so progressively that, these are really expensive things to have. I do think, going back to the specifics, and to answer your question, that it is Wells Fargo centric because of the asset cap. And, CEO Charlie Scharf has said that basically it's been hard for them and it's forced them to do things that they prefer not to do in COVID, during the COVID crisis.